There's a moment that happens quietly, almost invisibly, inside the machinery of global finance. No alarms, no headlines, no breaking news banners screaming across your screen. Just a number, changing, or sometimes not changing when it should. And in that silence, something much bigger begins to reveal itself, if you're paying attention. Right now, somewhere in the world, two people are buying the same thing, the same metal, the same ounce of silver. One of them is in Shanghai, reaching into their pocket, paying over $100 for something they can hold in their hand. The other is sitting in New York, staring at a screen, being told that exact same ounce is worth significantly less. Same metal, same moment. Two completely different prices. Most people would shrug that off. Different markets, different regions. Maybe a small premium here or there, but this isn't small. This isn't normal. This is a gap wide enough to ask a question that almost no one on financial television is asking. Why does the price rise when real buyers are involved and fall when it's just numbers on a screen? Because the truth is, what most people think of as the price isn't actually a price at all. It's a signal, a reflection. A number discovered in a place where contracts are traded in volumes so massive they dwarf the amount of actual metal that exists. Paper promises, exchanged at lightning speed, creating the illusion of abundance. But when someone asks for the real thing, when they want delivery, that illusion starts to crack. And then something strange happened. In the middle of a live trading session, with momentum building and prices climbing toward a critical level, everything stopped. Not slowed down, not lagged, stopped. The largest metals futures exchange on the planet went completely silent. No trades, no bids, no movement. Just a frozen number hanging in place while the rest of the world kept moving. Minutes passed. Then more. Natural gas markets came back online relatively quickly, but metals remained locked in that frozen state for far longer. 90 minutes of complete darkness. 90 minutes where no price discovery could happen. 90 minutes where the market simply didn't exist. And when it came back, it didn't recover. It dropped. Hard. Instantly. As if something had been reset. As if pressure that had been building was suddenly released in the opposite direction. No gradual adjustment. No smooth transition. Just a vertical move downward that wiped out positions in seconds. But here's the part that most people never see. During that blackout, the order book, the invisible structure of buy and sell orders that supports the entire market, was cleared. Orders placed by individual traders, carefully positioned entries, protective stops, gone. Erased. When trading resumed, the field was empty. And in that empty space, the fastest players in the world stepped in first. Algorithms don't hesitate. They don't need time to think or process. They act instantly. And in a freshly cleared market, speed is everything. By the time a human even understands what just happened, the game has already been rewritten. Now step back and look at the bigger picture. This wasn't the first disruption. In fact, it was the second in just a few weeks. For years, everything ran smoothly. Then suddenly, two significant events, both arriving at moments when the market was approaching levels that could create pressure on those holding large, short positions. That pattern might mean nothing, or it might mean everything, depending on how closely you're willing to look, because beneath the surface, something else has been happening, quietly, consistently. Day after day, week after week, the amount of silver available for delivery has been shrinking, not dramatically all at once, but steadily, like water draining from a reservoir. Each withdrawal small on its own, but together forming a trend that's impossible to ignore once you see it. And here's the critical distinction most people miss. Not all silver in a vault is actually available. Some of it is simply stored there, belonging to someone else. Only a portion is designated and ready to be delivered against contracts. That portion, the one that actually matters when someone demands physical metal, is the one that keeps getting smaller. At the same time, massive amounts of contracts are being pushed forward into the future. Obligations that should be settled now are being delayed, rolled into later months. On the surface, it looks like pressure is easing. But in reality, it's just being postponed. Because delaying a problem doesn't solve it. It just moves it further down the timeline. And while all of this is happening, something else refuses to align with the narrative. In Shanghai, the price doesn't collapse when Western markets fall. It holds. Sometimes it even rises. The gap between the two doesn't close, it widens. And that gap is telling you something simple but powerful. When people are buying actual metal, they're willing to pay more than what the screen says it's worth. That's not a glitch. That's information. And it gets even more interesting when you look at gold, a market larger, deeper, and typically more stable. Yet, even there, signs are emerging that everything isn't functioning as smoothly as it should. Contracts that should have been settled remain open. Delivery that should have been completed appears delayed. Not in massive headline-grabbing numbers, but enough to raise an eyebrow if you're paying attention. Now add in the supply side. The world's largest silver-producing regions are facing increasing challenges, rising costs, operational risks, instability that makes production more difficult, not easier. Supply doesn't just appear out of nowhere. It has to be mined, transported, refined. And when those processes become more complicated, the flow of metal slows down. So now you have a situation where demand for physical metal appears strong, available supply is gradually declining, and the system designed to balance those two forces is showing signs of strain. And then you have behavior. Investors who once relied on futures contracts, the most efficient way to gain exposure, are starting to shift, moving into vehicles that, while less efficient, feel more secure, because efficiency doesn't matter if the underlying promise can't be fulfilled. And when trust begins to erode, even slightly, capital starts to move in ways that reveal what people truly believe, not just what they say. But to be fair, there is another side to this story. Maybe everything that happened has a perfectly reasonable explanation. Systems fail. Technology breaks. Complex infrastructures sometimes need to pause to prevent larger problems. The sudden drop in price could have been nothing more than a cascade of automated selling triggered by volatility. The differences between markets might narrow over time as conditions stabilize. That explanation isn't impossible. In fact, it's entirely plausible. But here's where things become difficult to ignore. History has a pattern. Moments where trading stops at critical points. Moments where pressure builds beneath the surface, invisible to most until it reaches a level that can't be contained. And when those moments pass, the underlying reality doesn't disappear. It continues, quietly, until eventually it forces a repricing that catches everyone off guard. Because markets can only reflect perception for so long. Eventually, they have to reflect reality. And reality is not determined by what a screen says. It's determined by what someone is willing to pay when they want the real thing in their hand. So the question isn't whether one market is right and the other is wrong. The question is, which one is closer to the truth? Is it the market where contracts trade in enormous volumes, creating price signals through layers of leverage and abstraction? Or is it the market where physical metal changes hands, where buyers and sellers meet over something tangible? Maybe the answer lies somewhere in between. Or maybe, just maybe, the gap between those two is trying to tell you something that no headline ever will. Because in the end, the most important information in any market isn't what's being said out loud. It's what's being revealed quietly, in the numbers, in the patterns, in the moments when things don't quite line up the way they're supposed to. And right now, those moments are starting to add up.